Hi students, this is the first video of our valuations topic. In our valuations lectures, we are going to be covering various items or various topics in valuations. So in your textbook, if you would like to refer to that, we will be looking at chapter 6. So the focus of the valuations lecture is to revise what you learned in undergrad in Math 3A. So we are going to revise what you learned and then we are going to extend this knowledge. We are going to be looking at basic valuation concepts and myths in this video, being the first valuations video. We will also be looking at how to value bonds and debentures and preference shares using discounted cash flow methods. When we move on to value ordinary equity, we'll see there are various models that can be used. The various models that can be used are the dividend discount model, the price multiples method, the free cash flow models, EVA models, and then also asset-based or net asset value models. So in video 2, we'll be focusing specifically on the price multiples method. In video 3, we'll be focusing on the free cash flow models. So before we can look at the valuation methods, we need to understand certain concepts or ideas when we are valuing assets or valuing securities. So in corporate finance, the value of any asset will be determined by its future cash flows. So if we apply that when we value securities, we will want to know what is the expected future cash flows that are going to result from the security. And then based on when they are expected to occur in the future, we will present value these cash flows by discounting them at an appropriate discount rate. So from that, we can see that the things that are going to have an impact on the value will be the cash flow amounts and when these cash flows will occur. And then depending on when these cash flows occur, we will need to discount them by using an appropriate discount rate. So the discount rate will depend on the underlying risk of the security. So if we have an investment which has uncertain cash flows or discretionary cash flows, this will be valued less than an investment which has fixed cash flows or contractual cash flows. We will look at how to determine the required return when we look at cost of capital in week 15. Before we can look at the various valuation models, there are certain valuation myths that we need to think about. The first myth is that the model is going to give us an accurate value. We need to ask ourselves here, how is the value derived? So the value is often derived as a result of a formula or using a complex Excel model. So there are going to be inputs to this valuation model. So if we put in information that is not going to be accurate, we are going to get a value or answer that is not accurate. But if we put in accurate, well thought out information, then the answer you get is likely to be more accurate. So there are various inputs into the model which will produce an answer. But what we need to consider is what formed the inputs, what assumptions were made. We also need to consider what is the purpose of the valuation. So when we look at the inputs going into the model, it is important that we question the assumptions underlying those inputs. Another myth is that there is only one right answer. Valuations are made up of estimates about future cash flows and estimates of the cost of capital. As a result, these are approximations. Different people can value the same company and all come out with a different answer. So there is not one right answer. Often various valuation models will be applied and then the parties will negotiate as to what the final agreed price is. Another myth we need to consider is that valuations are objective. So often there will be biases, and we need to consider here who is preparing the valuation. If we are valuing a company to be sold, is the valuer the person who is going to be selling the company? And if it is, they will obviously want to obtain the highest price. So they may be over optimistic when forecasting future cash flows. Whereas if the valuation is performed from the perspective of the person who is going to be buying the company, in that fact, they may be more prudent and they may actually underestimate the future cash flows that will be derived. So therefore, it is very important to understand that valuations are objective, and often there will be certain biases based on the person or the people performing the valuation. Another myth is that valuations are valid over an extended time. Remember, we said that valuations are often based on future cash flows. Therefore, as more information becomes available as time goes on, these estimates could change in the future. And the last myth we will look at is that the value is key, meaning only the answer matters. So the answer is important, but there are certain benefits in carrying out a valuation. So if we carry out a valuation and we enforce a rigorous process, this will enable us to understand the fundamentals of the business and what drives the value. So if we understand what drives the value of a business, we will be able to determine any changes or any sensitivity of the valuation to changes in the variables making up the valuation. So the answer does matter, but the process of performing the valuation is also very important. As when we perform a valuation, this allows us to understand what drives the value and will enable us to determine the sensitivity of the value to changes in the variables making up the value. So the first item we are going to value are going to be debentures and bonds. So when we value debentures and bonds, we need to understand that the cash flows resulting from debentures and bonds are fixed cash flows, so they are often easier to value than equity, because equity, if we think about an ordinary share, usually the cash flow resulting from holding the ordinary share will be dividends, and a dividend is, in the case of ordinary shares, are not fixed. So it is more difficult to value equity than it is to value debentures and bonds, because debentures and bonds have fixed cash flows. So we know what will happen in the future, and then we take those cash flows and we need to present value them. So before we can value debentures and bonds, we need to understand certain terminology. The par value of a debenture or bond, this refers to the stated face value of the bond. So often bonds will be issued with a stated face value of 100 Rand, and companies will normally issue and redeem bonds at this price. Then we have coupon payments. So coupon payments are the fixed interest payments that the company is required to make on the bonds. So these can be semi-annually or quarterly, or they could be annual payments. The coupon interest rate is determined by taking the coupon payment divided by the par value. So when we look at the maturity date, most debentures or bonds will have a redemption date, which will represent the date that the bond will be redeemed. If we are dealing with an irredeemable bond, then there will not be a maturity date, but other bonds that are redeemable will have a maturity date, which will represent the date that the bond or debenture is redeemed. Then we have the yield to maturity. So the yield to maturity, this is the implicit return that an investor will earn when they hold the bond or debenture until maturity. So this represents the market yield on a bond. Now that we know all the terminology relating to debentures and bonds, we can actually look at the formula on how to value redeemable bonds. So when we look at redeemable bonds here, and we said that how we value a security in corporate finance is to look at the future cash flows. And then we will take those cash flows and we will present value them. So if we look at a redeemable bond, what are the future cash flows? Obviously, we'll have coupon payments made every period. And then because these bonds are redeemable, there's going to be a redemption amount. So both of these streams of cash flow, the coupon payments and the capital on maturity, these need to be present valued using the required rate of return. So you can see in the formula here, the value of the debenture is going to equal the coupon payment per period, and obviously depending on how often these payments are made, whether they are made semi-annually, annually, or quarterly, this will determine how they are going to be present valued. And then P in our formula represents the redemption of the principal amount. Depending on when the redemption is going to take place, it could take place in 3 years, it could take place in 5 years. This will also need to be present valued to get the value of the debenture or the bond. So when we are valuing debentures and bonds, we are going to value it from the investor's perspective, not the bond issuer's perspective. So the investor is the person who holds the bond. The company is going to issue the bond, and then a person is going to buy that bond and hold that bond. So the bond holder is the investor. So we are going to value the debenture or bond from the investor's perspective. So because we are valuing it from the investor's perspective, we are going to use the investor's pre-tax cash flows and the investor's required return. We need to value it from the investor's perspective. So our cash flows are going to be before tax, and we are also going to use the investor's required return. We are not going to use the company's cost of debt after tax. So just to reiterate, this is when we value a debenture or bond. When we do the WACC calculation, then we will look at it from the bond issuer's perspective. In other words, the company's perspective. But when you value a debenture or bond, it is going to be from the investor's perspective. So we will be looking at pre-tax cash flows and the investor's required return. Now that we know how to value redeemable bonds, we can move on to value those bonds that are irredeemable. So if bonds are non-redeemable or irredeemable, it means they will never be redeemed. So remember I said we are going to value a security in corporate finance by taking its future cash flows and present valuing these future cash flows using the required return. So if we have a non-redeemable bond, which means it will never be redeemed, what will the cash flows be? In this situation, the only cash flow is going to be the indefinite interest stream. Because these debentures are non-redeemable, the interest stream will happen indefinitely into perpetuity. So how we value the non-redeemable debentures or bonds, we need to take the indefinite interest stream and we need to discount this and find the present value by discounting it at the required return. So you can see here the value of a debenture or bond is to take the perpetual coupon payment and divide it by the required return. And again, we are going to use the cash flows and required return of the investor because we are valuing it from the investor's perspective, not the company's perspective. So our perpetual coupon payments and required return will be before tax. Now that we have looked at the formula of how to value debentures and bonds, let's have a look at a class example. So in our example, you are considering investing in the listed bonds of African Supplies Limited, which have the following characteristics. Our bonds have a face value of 100 Rand, and the coupon rate is 7% per annum, paid annually on 31 December. Our maturity date is 31 December 2019, and the current date is 1st of January 2015. If we look at the required A says, What would you be prepared to pay if similar bonds are trading at a yield to maturity of 8% or 6%? When will the bond trade at a discount or premium to its face value? And then we also want to explain the correlation between the bond price and the yield to maturity. So let's have a look at A, and then we'll come back and have a look at B separately. Okay, so now that we've gone through the question and the required, let's have a look at the solution for A. So we were told that the bond has a face value of 100 Rand, and then the coupon rate is 7% per annum, paid annually. So our coupon amount is going to be calculated by taking 7%, being the coupon rate, and multiplying this by the face value of 100 Rand. So our coupon amount, or our coupon payment, is going to be 7 Rand per annum. Then our coupon period, we were told that the current date is the 1st of January 2015, and the maturity date is 31 December 2019. So this means our coupon period is going to be 5 years. And then our capital redemption in 5 years is going to be 100 Rand. So this will be our future value. If we enter this into a financial calculator using a yield to maturity of 8%, we will get a present value of 96 Rand and 1 cent. So this present value represents the value of one bond. So when the yield to maturity is 8%, our present value is going to be 96 Rand and 1 cent. So why is the present value less than the face value? So this bond is said to be trading at a discount to the nominal value of 100 Rand. So the present value is less than the nominal value, which means it is trading at a discount. And the reason for this is that the yield to maturity is 8%. This is the required return, but the actual return that this bond is paying is 7%. So the actual return is less than the required return. Therefore, the value of this bond is going to be at a discount to its face value. If we look at the second part of A, here we want to know what would you be prepared to pay if similar bonds are trading at a yield to maturity of 6%. So the information for the bond is the same. The bond has a face value of 100 Rand, and our coupon payment will be calculated by taking our coupon rate of 7% and multiplying this by the face value of 100 Rand. So this is going to give us a coupon payment of 7 Rand per year. And our coupon period again is going to be 5 years, and the capital redemption in 5 years is going to be 100 Rand. If the yield to maturity is 6% and you enter all of these inputs into your financial calculator, you'll see that the present value of this bond when the yield to maturity is 6% is going to be 104 Rand and 21 cents. So here you would be willing to pay more than the face value. And why is this? The reason for this is that the yield to maturity, i.e. the required return, is 6%, which is lower than the return that the bond is actually paying. So this bond is said to be trading at a premium. It is valued higher than its face value. People are willing to pay more for this bond than its face value, and the reason for this is that it's paying 7% return, whereas the required return is only 6%. And then if we look at the third part of required A, when will the bond trade at a discount or premium to its face value? And we should then refer to the first two parts of required A. When the required return is greater than the actual return, the bond will be trading at a discount, meaning it will be valued at less than its face value. Whereas if the yield to maturity or the required return is less than the actual return, the bond will be trading at a premium to its face value. So based on these situations, we can see there is a negative correlation between the yield to maturity and the price of the bond. When the yield to maturity is greater than the actual return, the value of the bond is going to decrease. Whereas when the yield to maturity is less than the actual return, the value of the bond is going to increase and be greater than its face value. So now that we have answered A, let's go back to part B. So part B said, assume interest is paid semi-annually on 30 of June and 31 December, and that the yield to maturity on similar bonds is 7.5% per annum. What price would you be willing to pay for the bond? So here we have the same bond as in required A, except the interest, instead of being paid annually, is going to be paid semi-annually. So in 1 year, there are going to be 2 periods. So we need to calculate what is the coupon rate per period. And we will calculate this by taking the annual rate of 7%. This is the actual return or coupon payment divided by 2, because there are 2 periods in a year. And this will give us a coupon rate per period, being 6 months, of 3.5%. Then we want to know what is our coupon amount, and we will calculate the coupon amount by taking the face value and multiplying it by the coupon rate. So this is the coupon amount per period, which is going to be R3.50. Then we have our coupon period. How many periods are there? Remember, we said this bond is going to be redeemed after 5 years. So we will take 5 years, and each year has 2 periods. So we will take 5 years times 2, giving us 10 periods. Our capital redemption amount is still R100 at the end of 5 years. And they told us in the scenario for B that the yield to maturity on similar bonds is going to be 7.5% per annum. So if the yield to maturity is 7.5% per annum, we need to know what is the yield to maturity per period. So because there are 2 periods in a year, we are going to take the yield to maturity or required return, and we are going to divide it by 2, and that will give us a required return of 3.75%. If we input all of these into our financial calculator, we'll get a present value of R97.95. From the value of the bond, we can see that the value of the bond being R97.95 is less than its face value. So this bond is said to be trading at a discount. And the reason for this bond trading at a discount is because its actual return of 3.5% per period is actually less than the required return of 3.75%. So just to answer the required, what price would you be willing to pay for this bond? And the price you would be willing to pay is R97.95. And the reason why you would be willing to pay less than the face value is because the required return is actually greater than the actual return. So now that we have looked at how to value debentures and bonds, let's move on to preference shares. So when we look at preference shares, we need to remember that in the event of liquidation, our preference shareholders are actually paid before our ordinary shareholders. So preference shares are actually ranked ahead of ordinary equity. So the cash flow of preference shares in most cases is actually similar to bonds. So when you think about bonds, the coupon payments on the bond is typically a fixed amount. And in the same way, preference shares usually have a fixed annual dividend. So it is actually not that difficult to estimate what the future cash flows of preference shares will be. So because preference shares also have fixed payments, which are similar to bonds and debentures, we are going to use a similar valuation model as when we valued bonds and debentures. Obviously, this model is going to depend on the different types of preference shares. So we can have cumulative preference shares, redeemable preference shares, participating preference shares, and convertible preference shares. So in each of these cases, we will need to determine what is the future cash flow going to be resulting from this type of preference share, and then based on those future cash flows, we can present value them using the required return, and then this will give us the value of the preference share. So like I mentioned, we can value a preference share or any security by taking into account the estimated cash flow and the timing of that cash flow. And then we can discount these cash flows at the current market yield to determine the value. So just remember that. So this is the end of the first video of valuations. In the next video, we'll be looking at how to value ordinary equity using the PE multiples method.